In this video, we'll be talking about one of the most powerful smart money strategies. But before we jump right into the strategy, I'll first break down three key concepts. 1. Liquidity sweeps, what they are and how to identify a valid one. Then, we'll talk about fair value gaps and inverse fair value gaps. So let's get into it. What is a liquidity sweep? A liquidity sweep occurs when price takes out a swing high or a swing low in the market and then reverses in the opposite direction. However, it's important to understand that not every move above or below a swing high or low is considered a liquidity sweep. Let me show you how to identify a valid liquidity sweep. For a liquidity sweep to be valid, it has to be a quick move away from a swing high or a swing low. And in these two examples, you can see exactly what I mean. In the first example, price swept below and closed with a wick before reversing. And in the second example, price closed above the high, but immediately closed back below it before moving to the downside. That also signals a valid liquidity sweep because, as you can see, price took out retail stop losses. Immediately after taking out those stops, it reversed in the opposite direction, showing clear signs of institutional activity. Now let's look at an invalid liquidity sweep. From this image, you can clearly see the difference between a valid and an invalid liquidity sweep. In this case, price closed below the swing low, but instead of reversing, it continued moving to the downside. This no longer qualifies as a liquidity sweep. It becomes a market structure shift instead. Now let's talk about fair value gaps. Fair value gaps consist of three candles. In a bullish scenario, when the first candle's high does not overlap with the third candle's low, the gap left in between is known as a fair value gap. And in a bearish scenario, when the first candle's low does not overlap with the third candle's high, that gap there is also known as a fair value gap. These gaps act as magnets for price most of the time because they represent what we call an imbalance. The market always wants to fill these imbalances before continuing in its original direction. And the last concept we're going to talk about is inverse fair value gaps. Inverse fair value gaps occur when price closes above a fair value gap in a bearish scenario or below a fair value gap in a bullish scenario. When this happens, that fair value gap becomes an inverse fair value gap because price has actually inversed it. Now, since it has become an inverse fair value gap, price would most likely retest that area before continuing in the new direction. So, in a bearish scenario, when price closes above a fair value gap, it becomes an inverse fair value gap. At that point, we'll be anticipating that price will retest that level as support to continue pushing to the upside. And in a bullish scenario, when price closes below a fair value gap, it also becomes an inverse fair value gap. So in this case, we'll be expecting price to retest that level as resistance before continuing to the downside. So, since we now understand the three main concepts related to this strategy, the first thing we'll do is wait for a liquidity sweep in the market. After that liquidity sweep has occurred, we'll then wait for either an inverse fair value gap or a fair value gap so we can take advantage of the trade. Now, these are the two ways I personally like to trade it. The first way is by using just one time frame alone. I look for a liquidity sweep in that same time frame, and then I look for my fair value gap in that same time frame as well. The second way is by using multiple time frames. So I first look for a liquidity sweep in the higher time frame, then drop down to a lower time frame to look for my fair value gap. Both of them have their pros and cons. The single time frame approach might give you a lower risk to reward, but it usually comes with a higher win rate. On the other hand, the multiple time frame approach can give you a higher risk to reward, but sometimes price might stop you out before eventually moving in your direction. So really, it all depends on you and how you want to trade it. Let's now look at some examples. We'll start with examples using one time frame first. On this chart, the first thing we'll do is mark out the nearest swing high and swing low, then wait to see how price reacts when it gets to either of them. Here we can see that price went above this high and closed back down with a wick. That shows that institutional hands might be involved, or in other words, this might be a valid liquidity sweep. But before we can be sure, we have to wait for the next few candles to possibly move to the downside first, before confirming it as a valid liquidity sweep. And here, you can see that the next few candles actually dropped aggressively, leaving behind two fair value gaps. So we'll take our trade at the first fair value gap. Stop loss should go just above the high of the second fair value gap because the market might still reach that second gap before dropping. Take profit should be set at a 1 to 2 risk to reward ratio. And as you can see, price immediately tapped the first fair value gap and went straight to take profit. Now let's look at another example. Just like we did in the first example, the first thing we should do is mark out the nearest swing high and swing low and wait for price to sweep either the high or the low. Here, price swept the high and closed below, which is looking like a potential valid liquidity sweep. But before we confirm that, we have to wait for price to continue its impulsive move and create a bearish fair value gap. That will clearly signify that this is truly a valid liquidity sweep. And price just did that. So we take our trade from the first fair value gap. Stop loss can go above the second fair value gap, or you can risk it and place it just above the first one. Take profit should be set at a 1 to 2 risk to reward ratio. And as you can see, price went straight to take profit. Now for the third example, let's switch it up. Let's look at a bearish liquidity sweep that has an inverse fair value gap. Here we mark out the low and wait for price to react from there. And you can see how price reacted from that area. Unlike the first two examples, price closed below the swing low. But one very important thing to notice is how price actually reacted afterwards. In the next few candles, after price closed below the swing low, it also closed back above it, which is a very good sign. What now confirms this as a valid liquidity sweep is the close above this bearish fair value gap, which now turns it into an inverse fair value gap. So we can easily take our trade from there, stop loss just below the low, and take profit either at a 1 to 2 risk to reward, or you can target opposing liquidity. And as you can see, take profit was hit. I believe we now understand how to use one time frame to get our liquidity sweep and fair value gap. Now let's talk about how to use multi-time frame analysis. Let's look at an example. Here we mark out our swing high and swing low and wait for either one of them to get swept. Now we can see that price took out the high and left a wick behind. This is the most important aspect of the strategy. You should always wait for the higher time frame candle to close first and confirm that it's a liquidity sweep before jumping into the lower time frame. Because if you don't do that, you'll be exposing yourself to too many unnecessary losses. We have to first confirm from the higher time frame that it's a true sweep before heading to the lower time frame to look for an entry. So here, after we confirm that it was indeed a liquidity sweep, we now head to the lower time frame to look for an entry. And immediately after switching to the lower time frame, we can see a lower time frame liquidity sweep that left a fair value gap and also an inverse fair value gap, which is a very, very good sign. So we can take our trade from either one of them. Stop loss should go just above the high, and take profit should be set at the opposing liquidity. And as you can see, take profit got hit. Now there are thousands of this setup across the charts, but don't just take my word for it. Go and back test it and see how it works for you. Then make a few tweaks that fit your own trading style. If you want to learn everything related to smart money concepts, from market structure basics to advanced topics like liquidity, fair value gaps, and institutional order flow, you can grab your copy using the first link in the description below. It covers everything you need to know, explained step by step, so you can easily understand and apply it in your trading journey. If you enjoyed this video, give it a like and subscribe below.